Hello and welcome to another online class for financial management. In this quick lesson, we're going to talk about capital market a little bit. We're going to talk about some relationship between risk and return and whether we can learn something from this relationship. Basically, there are different kinds of return. There are different sources of return, different sources of money coming as a cash inflow to you as a result of an investment. For example, imagine why would people buy bonds? Well, bonds give us the following sources of cash inflow. Those would be coupon payments, and also their capital gains are also possible. That's if I buy a bond at a price lower than the price that I sell it for. Similarly, with investment into stocks, possible couple of cash inflows are dividends and also, again, capital gains. So if we put it in a formula, you know that I like to put things in a formula in this class. We can have something like our total return is going to be equal to the price that I might get after holding the asset, whether it's a bond or a stock, for one period, and I might get a dividend if it's a stock, or a coupon payment if it's a bond. Let's look at dividends first. Minus the amount of money that I originally paid, and then divided by that originally paid price for the investment. That would give me the return. For example, if I sell a stock for $120, and while holding that stock, I receive $10 dividend, and let's say originally I actually bought that stock for $100, this formula is going to give me an answer of 0.3, meaning that I have a 30% return. And actually we can split this ratio into two parts. That would actually be equivalent to new price divided by the original price as one ratio, and as another ratio, dividend divided by the original price. We split this formula into two parts because we have separate names for both of these parts. Dividend over the original price is called dividend yield, and the new price divided by the old price is, of course, capital gains. Hopefully you have capital gains, but of course capital losses are also possible when the price has dropped. Actually, this is capital gains yield. Capital gains itself is in the dollars rather than the percentages or the ratio. So we might have capital gains or we might have capital losses. That's because, of course, prices of shares or bonds are very volatile. And what history of capital markets tells us is that smaller company shares are more risky, more volatile. Looking at history again, we might notice that there is a relationship between risk and return. And the relationship is such that usually greater risk is accompanied by greater potential return. Of course, it's just a potential return because there is no guarantee that there will be any positive return. That's why it's called risky. The returns might actually be negative, but on average, with greater risk, there is greater return as well. And usually with the larger companies, generally risks are lower, the larger company shares are less volatile, but at the same time, the possible gains on average are also lower. Sometimes, of course, there might be some exceptions to that, but again, this is a general rule. Okay, so great risk and possibly larger gains, small risk and usually lower returns. What about the case of no risk? In finance, people say that short-term government bonds don't have any risk because the government can always print money if they have to pay off some debts that they accumulated. Of course, printing money reduces the value of that money that the bondholders receive, but that is a different question. We'll try to keep this class short, just like those short-term bonds. So they're called a risk-free asset, but even if the asset doesn't have any risk, there generally is some return as well. At least that's what finance professionals used to say traditionally. Nowadays, unfortunately, we see a lot of examples all over the world where government bonds are actually giving negative yields, negative returns. That's due to the 10-year strategy of governments reducing interest rates all over the world. But for now, just looking at the history of the capital markets, generally even short-term government bonds, which are kind of considered to be a risk-free asset, they have paid some return as well. So looking at a stock of company A, which let's say pays a return of this much, all of this amount is the return that you can get, whatever it is, 1, 2, 3, 4, 5, 6%, whatever. Compare that with the return from short-term government bonds, which is, well, let's say 2%. Let's say 2%. That's a risk-free return. Investing into this company A is risky, but even if it was not risky, you would still expect somewhere around 2% return. So out of this total 6% return on investment into company A, some of this return would be expected even if there was no risk. So this level of 2% would be expected if there was no risk at all. And this level is called risk-free rate of return. While this difference, the yellow area, the extra 4% for holding risk, also has a name, and that is a risk premium. Okay, so with a little bit theory out of the way, let's do some calculations. First thing I want to show you here is how do we measure risk? We measure risk using volatility and standard deviation. So let's have an example. Let's say you've invested into this stock B for 4 years, and let's say your return in the first year was 8%, your return in the second year was, say, 4.2%, return in the third year is, let's say, minus 4.3%, and the return in the fourth year is, let's say, 9%. Firstly, let's calculate your average return. Clearly, you can just use the formula average for that. There it is. On average, you're gaining more than 4.2%. And let's say the returns on a short-term government bond were, say, 3%, 2%, 1.5%, and 3%. Say you want to calculate the average risk premium on this stock B over the 4 years. So we need to look at the risk premium. That would be the difference, as you see here from this illustration, between the stock B returns and the returns of short-term government bonds. This is the risk premium in 4 years, and of course, we can calculate the average of that. An average risk premium is 1.85%. Next, how do we measure risk? Using variance. Actually, I should have variance here rather than volatility. Okay, so equals var.s, open the brackets, just enter the returns here. That gives you a volatility of 36.6 roughly. And actually part of the volatility formula, if you look into your textbook, is taking a power of 2, a square, taking a square of some of these returns. So the answer here is 36.6% squared. So the measurements are kind of strange here. So for that reason, we also use standard deviation. And standard deviation is just square root of variance. Square root of percent squared is just percent. So standard deviation has the same measurements as your returns. Standard deviation is just around 6%.